Once again, we are back. Hump Day Real Estate with Kendell, DMV. We have a guest coming in here in a second. Looks like it's Miss Laura might be coming back.
Hello. Hold on.
Miss Laura.
All righty. Almost there. Couple more buttons to click.
How are you?
It's like having a, button-a-thon all over your computer.
Hey, it's almost the end of the summer. Can you imagine that?
I don't want to think about it. I don't want the summer to end. So, because you know what happens, those holidays hit and it's like,
and it's all over. It's all over with.
It's like a freight train, the Acela Express right to the end of the year.
Well, that's why we're gonna pump some lead into some folks and get them to realize that they gotta jump on board and get into the real estate market before these holidays come in and derail everything.
Get in now.
Yep. So it is August the 31st. Wow. And we have Miss Laura back, and I had a question for you, Miss Laura. That's 1099 folks. What are they supposed to do when they're making good money, six figures even, and now they want to buy a home? What are those folks to do?
Well, there's two routes to go if you're 1099. One is preparation, as far as how you prepare your tax returns. Okay. And making sure you claim your income. You're going to claim your income from your 1099, but that you don't take every write-off that's known to mankind against your income. Because say you make 85,000 and you take 45,000 in deductions, costs, and those are costs that the IRS allows you to take, perfectly legitimate costs, but the underwriter, who's the person that approves the loan, will use the net as your qualifying income. So in that example, it would be 85,000 minus your 45,000 example expenses. You'd have 40,000 to qualify you for a home, not the full 85 that it says on the 1099. So that's like lopping your income in half. So you really qualify for quite a bit less house based on, that net number. Gotcha. And that's quite painful. So, and people that have a W-2 job, they have expenses too, but they can't write them off. So we count their full W-2 income, all of it gross, not even minus taxes or anything.
How does it work if that same borrower then said, hey, I forgot to tell you, I have a wife that she's a nurse. How does that work?
Well, then you can use both incomes. You would use the person, say the nurse is 1099. Now nurses can be, W-2, I'm sorry, I said it backwards. A nurse can be W-2, and many are, but there are other nurses that are on contract, like travel nurses are on contract, and they get a 1099, not a W-2. But if you have both, you use the tax return for the 1099 borrower and you use the W-2 for the other borrower. And then we combine their income together. Now we do have a loan special for 1099 buyers. And that loan, we use the 1099 income minus an expense factor, depending on what type of business they have. Okay. And like for example, I have a hairdresser and we examined her business and her expenses are about 10% of her income. And so we expense just 10%. So she got to use 90% of her income. So instead of her qualifying, when I looked at her tax return, she would have had close to $4,000 a month for her qualifying income. But using her 1099, we were minus the 10% expenses, we were able to give her about $8,600 a month income for qualifying.
So is that, where's that information coming from? Is that like a bank statement type of thing, or?
If the person is 1099, we can just use the 1099s. If they have, you know, say a contracting business and they have a Schedule C business, we would use their bank statements and use the deposits on their bank statements minus an expense factor. We do a little business analysis with a questionnaire that we fill out, and we minus an expense factor somewhere between 10% and, you know, it can be as much as 50%, but most of them are between 10 and 30% expense factor, depending on their business.
Gotcha.
So that works really well. You have to have strong credit in, you know, in the 700s, and 10% down is the minimum.
And that's better than the what I'm hearing out there, the 24-month bank statement programs, right? Because it's just using the 1099 minus the expense. Wow.
It's easier for the 1099 because that's less paperwork, because it's just 2 years, 2020 and 2021. If we're using their bank statements, we're going to get 12 months of bank statements. So that can be a little onerous to get 12 months of bank statements, but you can go to your bank and order them, and or some people can get 12 whole months online and print them up or save them as PDF and get those over to us. But I always get that loan approved, send it to underwriting so that we have that income calculated properly. You know, happy underwriter, happy loan process.
Gotcha. Now, you spoke of 2 ways. Do we talk about both? Because I know I interrupted.
Yeah, the one way is the full documentation standard way, but I was suggesting that people prepare in advance for if they're going to do full doc and actually start claiming less. And I probably wasn't as clear about it as, so we'll go over it again. So if you're going to work with your accountant and claim more income, you're obviously going to pay more taxes, but then we can do just a regular loan based on what you claim on your taxes. So sometimes people for a couple years claim all their income and take less deductions so that we can just do the old-fashioned paperwork way.
Gotcha.
But because for many years we did not have these programs, we didn't have programs for self-employed buyers and for 1099 buyers. They weren't available from the time of the 2008 crash until just, you know, really recently. So it's really a blessing for the self-employed community that we can serve them now with these loans that are very good. It's a fixed rate loan. You put 10% down, 15% down, 20% down. No mortgage insurance, even at the 10 or 15% mark. So the rate's a little bit above, but once you count in the mortgage insurance factor, it's really priced very well. It's a great loan. I'm happy to have them back because we really haven't been able to give our self-employed borrowers any options.
Yeah, because I talked to several folks, and one of the things that I'm hearing, like I have a guy that is in Florida, and he was talking about you know, he's driving Uber, but wants to buy a house there, but problem is his lady does a W-2 and then he did a 1099. And that's mainly why I was asking the question, because I'm like, what does people in that situation do?
We use the 1099 loan, but we calculate the other party's income just the same way. It's just like a hybrid, but it does fall still in the category of the 1099 loan. So you've got to do the 10% down, or if your credit score is a little lower, you can do the 15% down.
So is there any income requirements though? Is this just based off of this is what the numbers are versus the expenses, and this then you'll determine the buying power from that point? But
Yes,
there's
we just
nothing
need,
to.
yeah, you get the paperwork, fill out the loan application, gather all the needed paperwork. We do verify that they're employed. You can get a CPA letter, third-party letter saying that they are self-employed. And then we turn the file into underwriting without having a contract. So this is pre-contract, pre-house shopping. Get their loan approved, and then they can shop with a loan approval. Their loan is approved. It's been underwritten. Then they can go under contract, and it's, the hard part is pretty much done.
Gotcha. Wow. That's
Okay.
going to be great for a lot of people.
And that way you can play both sides, because then you don't have to, you can take advantage of all the IRS deductions and still get this loan, because you're either going to pay it to the IRS in taxes, or you save that money and put more money down and get this loan. You get a better tax deduction. Your mortgage insurance is not tax deductible, so it's in the interest rate. So it's a great way to go. And we've needed it. We really needed it to serve self-employed.
There's folk out there making good money. I mean, I ran into one of my clients last year. She jumped into a deal and jumped out on me, but I didn't know, like, there's the folks that actually have the moon bounces and stuff like that.
Like a rental company.
Yeah, it was in the like $200,000 range for the year. Like, she's out there killing it, right? So, but there wasn't, if she had written everything off, there wouldn't be a loan for her. But she did actually didn't write a whole lot off, so that it depleted her. So she was good for around 500,000 or 600,000. So
yeah, but when you're not taking all of your deductions, you're paying more in income tax to the government. Or you can do it the other way and put a little bit more down and, use this other form of loan and take all of your available legal, deductions that the IRS provides to self-employed buyers to take. So, it's kind of a scale. You're gonna pay here or pay there. But if you're putting more money down, because you have to put 10 or 15% down, that's still your asset. That's an asset called equity versus, your savings. But when it goes to the IRS, that's an expense. That's gone. That's not yours anymore.
a savings account that folks don't really know that they can have if they get into the real estate market and purchase a home.
And every time they make a payment, they get more equity, and they still get the market appreciation, and we're probably going to see 3 to 5% steady appreciation in housing. So you get that housing appreciation every month too. So you got a couple buckets there when you're in real estate, when you own real estate.
Well, let me jump into something, because you just hit on something that I was going to do at the end. But when you're talking about appreciation, being that when home prices increase, right? And then everybody's concerned now that about whether or not to get into the market, or because they purchase, is the property going to depreciate, right? Is when home prices decrease. But in the news, if anybody's really paying attention, we're not looking at appreciation or depreciation. We're looking at deceleration, which is that all it is is when home prices continue to appreciate, but at a slower, more moderate pace, right?
Right, because we were having double-digit appreciation in our real estate over the last year, some areas 2 years. So now we're having a normal market, single 3 to 5% appreciation. That is still appreciation. That is still the graph going up.
Yep.
So you're not, like, the space shuttle going straight up, but you're still appreciating, and
Yep.
that's
So so
still
so the numbers
adding
are
on
not,
to the value.
yeah, so the numbers are not going into your equity. It's still appreciation, just not at the pace where it was before.
Right. So, and when they're saying house prices are decreasing, they're saying that incorrectly. And there are quite a few newscasters that are saying it incorrectly.
And
It's
it's,
a decrease in the acceleration of the increase, which is very confusing when you
yeah,
can just say that it's increasing at a pace of 3 to 5%, which is completely normal from historic standards.
or the difference of what house, and what they're going to talk about that to be factual about what properties, what communities and markets are actually talking about, right? Because every market is not the same. And
Well,
so
you
that's,
do have some markets like the inner cities that are, a lot of them are struggling. I mean, we could name the one closest to us, which is Baltimore, which has the second highest crime rate in the entire country. They might be having a problem because, that's a little tough market when
well,
you're not running the city properly. So
well,
maybe there's pockets, but in general, most cities, most areas are appreciated.
Well, let me throw a little bone in there. I just went under contract on a listing I have in Northeast Baltimore, and in our area, 3 bedroom, 1 bath was nicely renovated, and we still got a 5,000 over in that market.
Mhm.
And I have 2 houses on the block, but the one with the finished basement that got more demand. So over 13 people threw the house over the weekend, and an offer in 2 days. So even in some of the areas of the city in Baltimore is still there's a demand because
Mhm.
folks they have the good credit, either they have the down payment assistance or they actually had cash. One of the buyers actually has her own money, so
Yeah, I
it's
mean,
still,
I love Baltimore. Baltimore should be one of the best cities in the whole entire country. It's a beautiful city, and there's plenty of great things there. Some of the best restaurants, top 10 restaurants in the world are in Baltimore.
yeah.
So it's a great place, but there's lots of room for improvement. But like you said, even there's areas that are still very well sought after. So, and
People
there
have the
is appreciation pretty much everywhere. And that's because the household formations, the number of people looking to get into the real estate market, especially our first time home buyers, which are in the 30 to 35 bracket, that's one of the biggest population segments. And we have millions of people looking for houses, and in general, and we have less than 1 million houses available. So you got a lot of people looking and not so much to look at, which has to push prices up, because that is economics 101, the supply and the demand curve. You have
Mhm.
short supply and a lot of demand, and that has to force prices up.
And one thing to add in there is for the people that uh, willing to live in the Baltimore area, you get in right at the right time before the you would miss the wave that DC renters probably miss by jumping on the boat of buying at the time where prices they went up. Average home prices are like 200,000 now, but and just like with the property I just put under contract at 175, you get in at that number and you're still beating the rent rate. And then as appreciation take you, actually now you have an opportunity to play in that game where I think a lot of folks in DC and other states actually that had those turnarounds, a lot of folks didn't get to play in that arena. So I think
Mhm.
it's a real good opportunity for folks if if you're going to live in Baltimore City anyway, I think you should think about the future of it and invest, right? And don't just allow, for you to help somebody else invest. You go and invest yourself, and you're going to live there anyway. Why not own the property I know that some people don't understand the dynamics of it, or even in some of the areas, they say, well, why would I want to pay X amount of dollars to live here? Why are you paying it every month? Not even knowing that you're paying,
And
what you're actually paying.
rents increase at the highest rate ever, 10%.
Yeah.
Year over year, 10%.
Yeah. So if you're at a,
So a lot of people, and some people, if the average is 10%, some people got a bigger increase than that. Some people got a little less, but some people got more.
Yeah.
So that's a big jump.
Yeah.
So and that's going up. That's been going up. The most rapid rent increase, since COVID started in history, since they've been documenting it. But yeah, there's a lot of misinformation out there. And if you really look at the charts and the numbers, which I do and you do, we know that real estate is valuable, and owning real estate is the cornerstone of probably your whole investment and your retirement accounts, having that.
Most of the richest folks that you talk to have real estate largely in their portfolio.
I don't know any, I don't know, but reading about super rich or reading about rich, or all of them own real estate.
Some sort of real estate.
All of them.
So
get in.
Yep,
and don't worry about the rate. Get the best. It's based on the credit score. So if you need help with your credit score, we can help you with that. But get in when if you can afford that payment comfortably. If you can make that payment, you're going to live somewhere. Live where you own it.
Yes. So let's talk about to some of those folks that are on that other side, the jumbo loans. I hear these jumbo loans, and I haven't worked with anybody to do one of these yet. So tell me a little about it. What is a jumbo loan?
Well, you have the big agencies, Fannie Mae and Freddie Mac and HUD, setting the loan limits, and they do that by the average cost. There's a formula: area, median income, and then the housing. Well, there's a big formula for it. So they determine annually what the loan limits are going to be, and it's county by county. So if you're above or if you're within the Fannie Mae, Freddie Mac set loan limits, that's a conforming loan, because your loan is going to conform to Fannie Mae, Freddie Mac, or HUD guidelines. HUD meaning FHA. So if you're not conforming to their guidelines, then you're a non-conforming loan, which is the same as saying a jumbo loan. So in our area, you have Howard, Carroll, Anne Arundel, and Baltimore counties all have loan limits. It's like $647,200. So that's the max loan amount for those areas. And that's actually a high balance loan. There's two different loan limits, but we're not going to go into the weeds here. So if you're above 647,200, and forgive me if there's a $50 on there, I don't recall, but then you're in a jumbo loan. So if you needed $700,000 loan, you would get a jumbo loan product and not a Fannie Mae, Freddie Mac, or HUD loan product if you were in those counties.
Gotcha.
Just talking about our area. Montgomery, PG, Prince George's, Montgomery, Frederick, Northern Virginia area are all in the Washington, they call it an MSA, and their loan limit is 970 and some change.
Gotcha.
So when you're above that, you're a jumbo loan. But jumbo loans have a different underwriting set of guidelines than conforming loan limits. They have tighter guidelines.
Gotcha.
They have tighter ratios requirements, larger down payment requirements, higher credit score requirements. And it's really because that sector, those houses have less marketability because less people can afford them. So it's a little more risky loan class for the lender to do jumbo loans. Because
Gotcha.
if they had to take the house back, say the person fell on super hard times and they had a foreclosure and they had to take the house back, there would be a smaller pool of buyers looking at those houses that could actually buy it. Just because it's hard to qualify, for $1 million plus or, in that arena. And you have to make a lot of money and have good credit, big down payments and stuff.
So is there a limit for jumbo loans?
Lender by lender,
Okay.
they put their own limits, but no, it's just the limit that the lender is comfortable with for, how big a loan they want to go up to.
Gotcha.
Some lenders specialize in jumbo loans, and that's really their kind of niche is jumbo loans. Some of the big banks, a couple of the regional banks, specialize in that. And it's also because like the banks have this department, the wealth management department. So they have clients that keep a lot of money with the bank and they give those clients like special rates and special, because they have all of the clients' money or a good portion of it.
Gotcha. Is there a difference between a 30-year fixed and a 30-year jumbo?
In interest rate, yes.
Okay.
They are not priced the same. Actually, sometimes jumbo is priced better than a conforming loan, and other times it's higher. It's kind of an attraction model. They can be wanting to attract more jumbo loans, so they make the pricing better. Or if that's their niche, they kind of buy the market by having very attractive jumbo rates.
Gotcha.
So generally speaking, a jumbo loan, you're putting 20% down.
Okay. And you guys do jumbos, right?
Yes, we do.
Okay.
And we do jumbo loans with 10% down. Or I can do a conforming first loan and stack a home equity line on top of it and get into like the million, $1.3 million, $1.4 million.
Gotcha. Can you elaborate on that a little bit? So what does that look like? So they got
So they get 2 loans instead of 1.
But you
And
said
that way
home equity though, so that
they get a home equity line.
gotcha.
So maybe they get a 970,000 first trust loan, and then they take say a 300,000 equity line that puts them at, what is that math? 1.27.
Okay. And so is that based?
1,270,000, and then they have their 10% down payment, and so they're really buying 1.3 whatever 5.7 house.
So that's the way.
So that gives them the ability to do a 10% down, but they have 2 loans. And then I would suggest the focus be pay off the second. And sometimes we do that when they have a house to sell, and then they just pay off the second when they sell their other house. And that way they just have the 1 loan left.
Wow.
They can do that, or they can do the jumbo. It just really depends. Every person's loan is different. Every person's financial situation is different. So we always offer them options and see let the numbers tell the story of which way to go.
Gotcha. Now, that HELOC, is that something that you do, that your company can do in general, or only when you're looking at like a jumbo product?
We can do a home equity line standalone, but only if it's like a bigger size one, like 150, 200, 250.
Okay.
If it's somebody needs 20,000, I just refer them to a couple of friends that I know that work and that's their space. And that's all they do is home equity lines. I just refer them because then, they avoid some of the closing costs and, yeah, because I can't do a loan that, small. So if they need a smaller just line, maybe to put a deck on their house or something like that, I would refer that out.
Gotcha, gotcha. So, you have any last words for us on and this about this crazy market or any either the loan products we was talking about?
I would say, please give us a call. And if you're thinking of buying, even if you don't know if this is the right time for you, but you're talking about it, you want to do it, it's one of your goals, then call us, talk to us. Let me give you options. Let me do a Zoom call and go line by line about what the options that you have, how much money you would need. We need to improve your credit score. We'll put a plan together doing that. But I'll also show you about interest rates, where they've been, where we think they're going to go, the cost of not doing it now versus doing it now versus waiting. What are those costs? I can show you graphs on where we're thinking appreciation is going to be and why we think that. Not just that we think this is going to happen, but why, from a historical perspective, are we making these projections? And get the education. We don't charge you a penny for all of this expertise and all of this education. And I put it in writing. It's in writing. It's on graphs. You can get a historical perspective, a current perspective, and a projection for the future. And then make a decision. Don't make a decision based on hearsay and what your cousin did or didn't do, and somebody had a terrible experience. We're going to give you a great experience, and we're also going to be there after you go to settlement. So we're going to be trusted advisors from, here on out, and you're going to win, win, win. But make a decision based on real education, on real facts, on something that you can see and hold in your hand. It's going to be on paper, in writing, and you're going to receive it. You can print it out. We can do seminars. We can educate your whole family. But turn off the TV. Stop listening to the little sound bites without any, perspective. It's
And
an unhealthy diet of false information.
come over to Hump Day Real Estate with Kendell and learn the real truth.
That's right. And then call us and let's just review your situation and give you the information that's particular to you. Because I've been doing this for 30 plus years. Every single client is a unique situation. Everybody's situation is different. So what your neighbor did or didn't do, or what your cousin did, or your Uncle Joe, it's all different because their situation is different than you. So let's find a unique plan for you and make it happen.
Hey, Miss Laura, thanks once again. We love when you get on because you give us the sound information that we really need. Folks, this is Hump Day Real Estate with Kendell, and we're signing off. You guys have a blessed remainder of the week.